Welcome to this special podcast, sponsored by Murphy Business Sales Edison, New Jersey office, where your business aspirations meet expert guidance. Whether you're looking to sell your business or explore new acquisition opportunities, we are here to support you every step of the way. Join us as our hosts deep dive into small business topics which are relevant for buyers, sellers, and other transaction advisors in the ecosystem.
You know, when you first start a business, there's this very specific, deeply comforting ritual you go through.
Oh, yeah. The paperwork phase.
Right. You go online, you file some forms with your state's Secretary of State, pay a couple $100, and a few days later, you get this certificate.
Usually with a really fancy gold seal on it.
Exactly. And it officially declares that you are a limited liability company or, a C corporation. And the moment you hold that piece of paper, you feel this profound sense of security.
You do, because you assume you've just built this massive, impenetrable concrete wall between your business life and your personal life.
Yeah, the logic is if the business fails, well, the business fails. But my personal savings, my house, my kids' college fund, those are safe behind the wall.
It's basically the founding myth of modern entrepreneurship. We're all trained to believe that the corporate entity is this magical shield. The phrase limited liability is right there in the name.
Right in the name.
So people naturally assume the risk is entirely compartmentalized. Like the business takes a hit and you get to walk away clean.
But then, you step out of that startup phase and into the real world. You start dealing with commercial lending, complex vendor contracts, federal tax codes.
And that's when the illusion cracks.
Big time. Because if you actually read the fine print of the agreements you're signing just to keep the business afloat, you realize something terrifying. That massive concrete wall, it's actually a chain link fence, and it is full of holes.
Yeah, the legal and financial landscape for small business owners is incredibly murky. And honestly, if you don't understand the mechanics of how your liability actually works, you can lose absolutely everything.
Which is wild.
The problem is that owners usually only discover those holes when the business is already in distress. And by that point, I mean the momentum of failure is already dragging their personal assets over the edge.
Right. Which brings us to the core purpose of today. Welcome to today's deep dive. We have a very clear mission for you today. We are building the ultimate survival guide for small business owners facing financial distress.
A roadmap for the worst-case scenario.
Exactly. We're going to map out exactly how to avoid the cascade of really unforced errors that drag a struggling business into bankruptcy. And more importantly, we are dissecting the hidden legal trapdoors that can just wipe out your personal wealth when a business goes under. Okay, let's unpack this.
We really have to unpack it because the economic indicators flashing right now are, well, they're severe.
Yeah, and to get to the bottom of this, we're pulling from a massive stack of source material. We've got legal frameworks from Mintz Presidium Law, the Anderson Hunter Law Firm, Tapman Legal, and Anthony Batty.
Right, and we're cross-referencing those legal strategies with the actual IRS tax codes, plus the latest United States courts bankruptcy statistics. And that's data running straight through the first quarter of 2026.
And we aren't just stopping at the law either. We've layered in financial survival analyses from QuickBooks, Debt.org, the Liberty Capital Group, and Merchant Growth.
It's all data.
It is. But the overarching theme across every single one of these sources is this desperate warning, which is simply having an LLC does not protect your personal life if you make the wrong moves during a cash flow crisis.
No, it doesn't. And to understand why those moves are so critical right now, we really need to look at the macro environment.
The big picture.
Exactly. The U.S. courts data for the 12-month period ending March 34 in 2026 paints a really stark picture. Total bankruptcy filings hit 591,850.
Wow. Over 500,000.
Yeah, that is an 11.9% surge from the previous year. And if you isolate just the business filings, they rose to 25,960.
That's a massive spike in commercial failures. But, I want to look at the underlying mechanics of that failure. Because a business doesn't just fail in a vacuum, right?
Right. There's always a catalyst.
So what's the engine driving this wave of bankruptcies right now?
If we connect this to the bigger picture, the engine driving this is the absolute depletion of the American consumer.
Oh, interesting.
Yeah, think about it. Small businesses are essentially the transmission system of the economy, but consumer spending is the fuel. And right now, the fuel lines are completely dry.
Just tapped out.
Exactly. Our financial sources point out that the massive savings buffers that households built up a few years ago, they are entirely gone. We're seeing persistent inflation, paired with incredibly restrictive monetary policy.
So borrowing costs are sky high for everyone.
Exactly. And by late 2025, national household debt reached an unprecedented $18.8 trillion.
18.8 trillion. I mean, when household debt hits that level, consumer behavior fundamentally changes, right?
Oh, absolutely.
They aren't buying that extra coffee, they're not renovating the kitchen, they're canceling software subscriptions.
Precisely. And the data actually proves this behavioral shift. Look at Consumer Chapter 7 liquidations.
Which is basically the absolute last resort bankruptcy, right?
Right. It's filed when an individual has literally zero disposable income and no mathematically possible way to repay their debts. Well, those filings surged by 20%.
Wow.
So when your core customer base is liquidating their own lives, your small business revenue doesn't just dip a little. It falls off a cliff.
Like the economy is an ocean, right? And consumer spending is the tide. When the tide goes out, the small businesses are the ones left stranded on the rocks.
That's a perfect analogy.
But wait, I was reading through the Mint's legal breakdown, and it highlighted this really fascinating disparity. Large corporations are facing the exact same macroeconomic drought, right? The same inflation, the same consumer pullback.
Yes, they are.
Yet they aren't flooding the bankruptcy courts at the same rate. Why is a multinational retail chain surviving while the local brick and mortar is filing for Chapter 11?
That difference comes entirely down to the mechanics of liquidity and leverage. Large corporations just have access to these highly sophisticated private credit channels.
So they can borrow their way out of it.
Basically, when a massive corporation hits a cash flow crisis, they execute what the financial industry calls liability management exercises, or LMEs.
Okay, what does an LME actually look like mechanically?
Well, it happens entirely out of court, which is key. A large corporation will quietly approach a private equity firm, or maybe a massive hedge fund, and they'll negotiate this complex restructuring of their bonds.
Like trading old debt for new debt.
Exactly. Swapping old debt for new debt with longer maturity dates, or they might issue new equity to raise emergency cash. They basically have an army of financial engineers designing a custom parachute for them.
Whereas the small business owner just has, what, a standard commercial bank loan. And the local bank isn't exactly interested in creative financial engineering.
Not at all. Small businesses lack those alternative liquidity channels. When their revenue drops, the bank just demands the monthly payment. There is no private equity bailout coming.
So they're cornered.
Right. They are forced into rigid, court-supervised restructuring or complete liquidation. And because they're cornered, the owners panic.
Which is totally understandable.
It is, but this is where the unforced errors begin. They panic and borrow toxic, high-interest debt just to cover payroll. They start ignoring their cash flow forecasts because, honestly, the numbers are too depressing to even look at.
They just put their head in the sand.
Exactly. They completely lack a contingency plan, and they wait until the bank accounts are literally overdrawn before they ask for professional help.
Let's focus on that panic, because that is where the battle is actually won or lost. The Presidium law source was incredibly adamant about this. The most reliable way to survive bankruptcy is to avoid the courtroom entirely by acting while you still have a shred of leverage.
Yes, timing is everything.
So I want to build a practical, mechanical, pre-bankruptcy playbook for you, our listener. Say I'm a business owner, my revenue is down 30%, my cash reserves only last another 2 months. I have not called a lawyer yet. What is my very first move?
Your absolute first move is aggressive working capital optimization.
Okay, that sounds like corporate jargon. Let's define that mechanically.
Fair enough. It means you must immediately convert every possible asset you have into liquid cash right now, today. And you start with your accounts receivable.
So collecting from the people who owe me money. But if the economy is bad, they're probably dragging their feet too, right? Like net 30 terms are suddenly stretching to net 60 or net 90.
Which is exactly why you have to change the math for them. You offer steep prompt payment discounts.
How steep?
Well, you call your client who owes you $10,000 in 60 days, and you say, look, if you wire me the funds by tomorrow morning, I will accept $8,500 as payment in full.
Oh, man. I can hear business owners screaming at their speakers right now. They're saying, I operate on a 15% profit margin. If I give a 15% discount, I am literally doing the work at a loss. Why would I intentionally bleed my own margins dry?
Because you are confusing profitability with survivability.
Oh, that's a crucial distinction.
It is. In a distress scenario, profit margins are completely irrelevant. Cash is oxygen. A business can survive for years without making a profit, but it will die in 3 days if it cannot make payroll.
Wow. Yeah, that puts it in perspective.
Right. Getting 85% of your cash in the door today gives you the oxygen to survive the month. Waiting 60 days for a 100% of the cash pretty much guarantees you will be out of business before the check ever arrives.
That is a brutal reality check, but the mechanics make perfect sense. It's triage. Okay, so what's the next step in the playbook?
You apply that exact same triage mentality to your inventory. If you have products sitting in a warehouse or on a shelf that haven't moved in 90 days, that is trapped capital. You must ruthlessly liquidate it.
Again, I feel like the psychological barrier here is the sunk cost fallacy. The owner looks at the warehouse and thinks, but I paid $50,000 for that inventory. I can't sell it to a liquidator for $20,000.
But the reality is, the money is already gone. The $50,000 is spent. The only question that matters right now is whether you'd rather have a warehouse full of dusty boxes or $20,000 in your checking account to pay your commercial rent.
You really have to divorce your emotions from the ledger.
Completely. And that naturally leads to the next crucial move. You must bring in a dispassionate third party. Engage a certified public accountant immediately to execute an expense restructuring.
Why can't the owner just cut the expenses themselves, though? I mean, they know their business better than anyone.
Because owners are deeply emotionally attached to the architecture of their business.
Ah, right.
They'll justify keeping a software subscription because they like the interface. Or they'll keep a marketing agency on retainer because the account manager is the personal friend. Or they refuse to downsize an office space because it feels like an admission of defeat.
Yeah, pride gets in the way.
Exactly. A CPA does not care about your ego. They will look at the math, identify the non-essential overhead, and sever it without a second's hesitation.
All right, so we've pulled cash in through discounts and liquidations, and we've cut the easy overhead. But what about the massive fixed costs? Like, the elephant in the room for most failing businesses is the commercial lease and the core supplier contracts.
Right, the really heavy anchors.
Yeah. How do you restructure an ironclad legal contract when you basically have zero leverage?
Well, you actually have far more leverage than you realize. The third move in the pre-bankruptcy playbook is renegotiating those exact contracts. You approach your suppliers and you ask to shift your payment terms from net 30 to net 60 days.
And what about the landlord?
You approach your commercial landlord and you ask for a rent deferral, temporary reduction, or maybe a lease extension at a lower monthly rate.
Okay, let's role play the mechanics of that landlord conversation because I think a lot of owners are terrified of it. They assume the landlord is just going to laugh, point to the lease, and hand them an eviction notice. What is the actual psychological and economic dynamic happening across that table?
You have to look at the situation from the landlord's balance sheet. The landlord is essentially holding a risk assessment matrix.
Okay, how so?
If they evict you, what happens? First, they have zero rental income immediately. Second, they have to hire an attorney to execute the eviction, which costs thousands of dollars. Third, they have to hire a commercial broker to market the empty space, and they pay a massive commission on that.
And the space might need work, right?
Exactly. Fourth, they might have to offer a tenant improvement allowance just to convince a new business to move in. And in a down economy, that space might sit completely empty for 8 to 12 months.
So the transactional and litigation costs of replacing you are just catastrophic for them.
Immense. The cost of a vacancy is immense. So when you approach them, you do not beg. You present a mathematical reality.
What's the script?
You say, look, my revenue is down 30%. I am restructuring my operations to survive. I can afford to pay you 60% of my rent for the next 6 months. If you cannot accept that, I will be forced into Chapter 7 liquidation next week, and you will get zero.
Wow, just laying it all out.
Right. And faced with a 40% haircut versus a total loss and a year-long vacancy, a rational landlord will take the haircut. It's essentially a mutual survival pact.
So what does this all mean? It completely reframes the entire power dynamic. You aren't asking for a favor, you're actually offering them a better alternative to a catastrophic default.
Exactly.
But let's say you do all of this, you optimize, you cut, you renegotiate, but you still have a cash gap. Our sources discuss finding alternative capital. But traditional banks aren't lending to distressed businesses. What mechanisms actually work here?
Well, you have to look outside the traditional banking system, mostly to avoid toxic short-term debt traps. I mean, getting a high-interest merchant cash advance is one of the most fatal unforced errors a distressed business can make.
Because of the daily payments?
Yes. The daily draw from your bank account will just suffocate whatever cash flow you have left.
So where does the capital come from then?
You look at equity partners or angel investors who might be willing to buy a minority stake at a distressed valuation. Or, depending on your situation, there are highly specialized avenues.
Like what?
Well, for example, if your business is currently involved in a commercial lawsuit as a plaintiff, say you are suing a vendor for breach of contract, our sources highlight the use of pre-settlement lawsuit funding.
Okay, how does that work mechanically?
A specialized funding company evaluates your lawsuit. If they believe you have a really strong chance of winning, they will give you a cash advance against the future settlement.
Wait, so they're just betting on your lawsuit?
Basically, yes. And
Yeah.
the brilliance of this mechanism is that it is non-recourse. If you lose the lawsuit, you do not have to pay the advance back.
Really?
Really. And because it is technically an advance on an asset, not a loan, it doesn't impact your business credit score and it doesn't increase your debt-to-income ratio.
That is a phenomenal tool to keep in the arsenal. But I want to pivot a bit because the reality is when the walls are closing in, business owners get desperate. And in that desperation, they reach for capital that comes with hidden strings. They sign a document that utterly destroys that concrete wall of limited liability we talked about at the top of the show.
Yes, we were walking right over the most dangerous hidden trapdoor in modern small business finance. The personal guarantee, commonly referred to as the PG.
I hear this myth constantly from new entrepreneurs. They say, look, I registered an LLC, I got an employer identification number, an EIN from the IRS, and I opened a dedicated business bank account. The business is its own legal person. Therefore, my personal credit and my personal assets are completely insulated.
And the Liberty Capital Group source thoroughly dismantles this illusion.
How so?
Because from a purely theoretical legal standpoint, yes, the LLC is a separate entity. But from a practical commercial lending standpoint, that separation is totally meaningless. Lenders are not naive. They understand the mechanics of small business failure perfectly.
They've seen it a million times.
Exactly. They know that an LLC can be legally dissolved on a Tuesday, or the owner can simply empty the business checking account and vanish on a Wednesday.
So when you apply for a loan or a lease in the name of your LLC, the lender is just looking at a blank piece of paper.
Precisely. They are facing a classic economic problem known as information asymmetry.
Let's break down the mechanics of information asymmetry. How does it actually dictate the lending relationship?
Think of it like buying a used car from a private seller. The seller knows every single thing wrong with that car. They know the transmission slips when it gets hot. They know the radiator leaks.
Right. But you, the buyer, only see the shiny paint job.
That is information asymmetry. In commercial lending, you are the seller. You know the intimate, unvarnished truth about your business. You know if you're secretly planning to pivot the business model, or if your top salesperson is about to quit, or if a major competitor is moving in across the street.
But the bank.
The bank only sees your sanitized profit and loss statement.
So the bank is essentially flying blind. They have to assume you are hiding this slipping transmission.
Exactly. So to solve this imbalance of risk, the lender deploys the personal guarantee. They slide a piece of paper across the desk and say, "We will lend this money to your LLC. But if you truly believe in the viability of this business, you need to co-sign this note as an individual. You need to put your own house, your own retirement account, and your own credit score on the line."
It perfectly aligns the incentives, doesn't it? If the owner knows their own personal survival is tied to the loan, they will move heaven and earth to make those payments.
Exactly.
But our legal sources make it really clear that not all personal guarantees are the same. There are specific, distinct legal mechanics depending on what you sign, and understanding those mechanics dictates exactly how much of your life you can lose. Let's walk through the different types of PGs.
Sure. The most common, and frankly the most dangerous, is the unlimited guarantee.
Sounds ominous.
It is. Mechanically, this means your personal liability has absolutely no ceiling. You are guaranteeing 100% of the outstanding loan balance. But it doesn't stop there. You're also guaranteeing all accrued interest, all late penalties, and crucially, all of the lender's legal fees and collection costs.
Wait, explain how those collection costs escalate.
Let's say your business defaults on a $100,000 loan. The bank hires an aggressive corporate law firm to hunt down your assets, file liens, and bring you to court. That law firm might bill $40,000 in legal fees over a 6-month period.
Oh, wow.
Under an unlimited guarantee, you don't just owe the $100,000. You are personally legally obligated to pay the $140,000. They can drain your life savings just to be the lawyers who sued you.
That is horrifying. What is the alternative? Like, is there a way to cap that exposure?
Yes, through what's called a limited guarantee. In this scenario, the mechanical language of the contract specifies a strict ceiling. It might cap your personal liability at a specific dollar amount, say $50,000, regardless of how high the total business debt climbs.
Or maybe a percentage.
Right, it might cap it at a specific percentage of the total debt. This is significantly safer because it allows you to accurately model your worst-case personal scenario.
And what happens when a business has multiple owners? Say I own 40% of an LLC and my partner owns 60%. Do we both sign a PG?
You do, and this introduces two new mechanical variations. The fairer of the two is several liability.
How does that work?
Under this structure, your personal guarantee is strictly proportionate to your ownership stake. If the business defaults on a $100,000 loan and you own 40% of the company, the bank can only come after you personally for $40,000. Your partner is on the hook for the remaining $60,000.
That seems entirely rational, but there's a fourth variation that our sources flag as an absolute nightmare for multi-partner businesses.
Yes. It is called joint and several liability. If you sign a PG with this clause, you are giving the lender a terrifying amount of power.
Why? Mechanically, what does it do?
Mechanically, it means that the lender can choose to pursue any single partner for 100% of the total debt, completely ignoring the ownership percentages.
I want to spend some time on this because the Liberty Capital Group's source provided a case study that really highlights how devastating this mechanic is. Let's look at the story of Sarah and Jason.
It is the perfect illustration of this trap. So Sarah and Jason were 50-50 partners in a small manufacturing business. They needed capital, so they took out a $200,000 SBA loan. To secure the funding, they both signed a personal guarantee that included a joint and several liability clause.
Okay, so they get the money, but unfortunately, the macroeconomic tide pulls them under. The business fails, they liquidate everything, and after the dust settles, the business still owes the bank $150,000.
Right. Now, in a logical world, Sarah would owe $75,000 and Jason would owe $75,000. But Jason is completely broke. He has no personal assets. His bank accounts are empty, and he immediately files for personal Chapter 7 bankruptcy. His liability is wiped out by the federal court.
So what does the bank do? Do they just write off Jason's half and send Sarah a bill for $75,000?
Absolutely not. The bank doesn't care about fairness. They care about recovery. Because of the joint and several clause, the bank simply pivots 100% of their legal firepower towards Sarah.
Oh, no.
Yes. They sue her personally for the entire $150,000. The fact that her partner went bankrupt doesn't protect her. It actually weaponizes the entire debt against her. The bank knows she has equity in her home, so they place a lien on her house to force the collection of the full amount.
So by trying to build a business with a partner, she actually doubled her personal exposure because she didn't understand the mechanics of the legal phrasing she signed.
Exactly.
But I want to contrast this corporate reality with another common structure. What if I am a freelance graphic designer or, solo plumber? I didn't form an LLC. I'm just operating as a sole proprietor under my own name. Do these PG rules apply to me?
If you are a sole proprietor, you don't even need to sign a personal guarantee to be exposed.
Right.
Because there is absolutely zero legal separation between you and the business. You and the business are the exact same legal entity. If the business is sued, or if the business defaults on a loan, your personal assets, your home, your car, your children's college savings, they are instantly, automatically on the chopping block.
Is there any buffer at all for a sole proprietor?
It depends entirely on state law. The Anderson Hunter law firm source breaks down how some states offer specific, limited exemptions to prevent you from becoming completely destitute.
Do you have an example?
Sure. In Washington state, for example, a sole proprietor facing business debts might be allowed to exempt a modest vehicle, a small portion of equity in their primary residence, and up to $15,000 worth of the tools of their trade.
So the plumber gets to keep his wrenches, but the bank takes his savings account.
Precisely. Beyond those very narrow statutory exemptions, a sole proprietor is fully exposed to the elements. This raises an important question, though. We've established that the LLC only works if you don't sign away its protection via a personal guarantee.
Right.
But let's assume an owner is very savvy. They have an LLC, and they somehow manage to get vendor credit without signing a PG. They think their concrete wall is fully intact. How do they accidentally destroy their own protection from the inside? How does the corporate veil get pierced?
Oh, that's a great point. How does that happen?
The corporate veil is pierced when an owner treats the legal structure with operational sloppiness. Courts rely on a legal concept called the alter ego theory. Mechanically, a judge looks at your business operations and asks, is this LLC truly functioning as an independent entity, or is it just a hollow shell acting as the owner's alter ego?
How does a judge determine that, though? Like, what are the actual red flags?
The most common fatal error is the commingling of funds. You open a business checking account, but you use the business debit card to pay for your personal groceries, your Netflix subscription, or your family vacation.
Oh, I know business owners who do that constantly. They figure, I own 100% of the LLC, the money is all mine anyway, I'll just sort it out with my accountant at tax time.
That is a disastrous mindset. The moment you treat the business bank account like your personal ATM, you are legally declaring that the business and you are one and the same.
And a judge will hold you to that.
Exactly. If you make that declaration, a judge will agree with you. When a creditor sues the business, the judge will pierce the veil and allow that creditor to treat your personal bank account like the business's ATM.
Wow. So commingling is strike one. What else destroys the veil?
Failing to observe corporate formalities. If you have a corporation, state law requires you to hold annual meetings, record board minutes, and maintain updated bylaws. If you ignore all that paperwork because it feels tedious, you're signaling to the court that the corporation is a sham.
And strike three.
Severe undercapitalization. If you start a business that inherently carries high risk like a construction company, but you only put $100 in the business bank account, you're essentially setting up a shell company explicitly designed to defraud creditors when things inevitably go wrong. The courts will see right through that and pierce the veil immediately.
Okay, so the personal guarantee is a contractual trap you sign into. Piercing the veil is an operational trap you stumble into. But as terrifying as those civil liabilities are, our sources outline a statutory trap that makes them look like a minor inconvenience.
Yeah, they do.
It is the ultimate nightmare, and it involves the raw power of the federal government.
Yes. We have to discuss the IRS Trust Fund Recovery Penalty, or the TFRP. This is the exact moment where routine small business mistakes cross the line from a civil debt issue into a severe, inescapable federal liability.
I want to speak directly to you, our listener, for a second. If you own a business with employees, you know this exact panic. It's Thursday night, payroll is due on Friday, your accounts receivable haven't cleared, you are staring at your business bank account, and you only have enough cash to do one of two things. You can pay your landlord so you don't get locked out of your building on Monday, or you can remit the payroll tax deposit, the income tax, and FICA contributions you withheld from your employees' checks to the IRS. What happens next?
Well, the owner feels cornered, and they make a catastrophic rationalization. They think, if the landlord locks the doors, the business dies today. If I delay the IRS payment, the business survives the week, and I'll just make double the tax payment next month when that big client finally pays my invoice.
So they use the withheld employee payroll taxes to pay the commercial rent.
Yes.
But the big client never pays, the business fails anyway, and now the IRS is missing their money. Why is the IRS response so incredibly aggressive compared to a normal creditor?
Because you didn't just fail to pay a corporate tax bill. You took money that belonged to your employees, which they entrusted you to hand over to the government. Those funds are legally held in trust. They never belonged to your business in the first place. Therefore, when you fail to remit them, the IRS completely ignores the corporate veil. They do not care if you have an LLC, a C Corp, or an S Corp. They bypass the entity entirely and trigger the TFRP.
How does the TFRP work mechanically? Who exactly do they target?
The IRS will assess a penalty equal to 100% of the unpaid trust fund tax against any individual they deem to be a responsible person who willfully failed to pay the tax.
Okay, I need to push back on that specific legal terminology. When a normal person hears the word willfully, they assume malicious intent. They assume the IRS is looking for an owner who embezzled the payroll taxes to buy a yacht in the Bahamas. Does willful require malice?
Not at all. And that is why this trap catches so many honest, hardworking business owners. The IRS defines willful purely mechanically. Did you know the tax was due?
Yeah.
Yes. Did you have access to the funds? Yes. Did you intentionally sign a check to pay a different creditor like the electric company or the landlord instead of the IRS? Yes.
Wow. So simply prioritizing the survival of your business over the IRS tax deposit meets the federal legal definition of willfulness.
Exactly. You didn't steal the money for a yacht. You used it to keep the lights on and keep your employees working. The IRS does not care about your noble intentions. If you directed the money elsewhere, you are personally liable.
And the severity of this penalty is absolute, isn't it? If I owe $50,000 to a vendor, I can negotiate. Or I can file personal bankruptcy. What happens with the TFRP?
The trust fund recovery penalty is fundamentally non-dischargeable. You cannot wipe it out by liquidating the business in Chapter 7. And if they assess it against you personally, you cannot wipe it out by filing for personal bankruptcy. It is a permanent anchor.
Mechanically, what powers does the IRS have to collect that?
They have a 10-year statutory collection window, and their powers are terrifying. They do not need to take you to court to get a judgment. They can unilaterally issue a levy against your personal bank accounts, freezing your funds.
Without a court order?
Correct. They can send a garnishment order to your future employers, taking a massive percentage of your paycheck for the next decade. They could file a federal tax lien against your home, meaning you cannot sell or refinance your property without paying them first.
Here's where it gets really interesting, though. Our legal sources point out a really tragic irony. When owners realize the sheer terror of the IRS coming for their personal wages in their home, they panic. They realize they have to pay this TFRP immediately, but they don't have the cash. So what do?
They try to shift the debt. They pull out their personal credit cards, or they take out a high-interest personal loan, or they take a second mortgage on their house, and they use those personal funds to pay off the corporate payroll tax debt.
Right. They think they've solved the problem. They traded an inescapable IRS debt for standard consumer credit card debt. And consumer credit card debt can be wiped out in personal bankruptcy, right?
That is the logical assumption, but it is a fatal misunderstanding of bankruptcy law. Let's trace the mechanics of what happens next. The business eventually fails anyway. The owner is now drowning in that personal credit card debt they used to pay the IRS. They file for personal Chapter 7 bankruptcy, hoping for a clean slate.
But the bankruptcy trustee looks at the credit card statements.
Precisely. The trustee reviews the history and sees that the $50,000 credit card balance wasn't used to buy groceries or a car. It was used specifically to pay a non-dischargeable federal tax. Under the bankruptcy code, the court can rule that the nature of the debt transfers. Because the credit card was used to pay a non-dischargeable obligation, the credit card debt itself may be deemed non-dischargeable.
So you took a corporate tax problem, converted it into personal debt, paid 20% interest on it, and you still can't bankrupt it. It is a cascade of compounding unforced errors. You ignore cash flow, you pay the landlord instead of the IRS, you panic borrow on your personal cards, and suddenly your financial life is ruined for a decade.
It is the ultimate cautionary tale of why you must never, under any circumstances, use trust fund taxes as operating capital.
Okay, we need to pivot to solutions. Let's assume a business owner is listening to this and they haven't messed with payroll taxes, but they are drowning in legitimate, unmanageable commercial debt. They are cornered, but they want to avoid the massive expense and the public spectacle of federal bankruptcy court. What are the formal restructuring tools available? Our sources outline a fascinating mechanism called an ABC.
Yes, an ABC stands for an assignment for the benefit of creditors. It is one of the most effective yet least understood tools for winding down a business.
I want to do a deep dive into how an ABC actually functions compared to a standard federal Chapter 7 liquidation. Let's break down the mechanics. If I file Chapter 7, I file a petition in federal court, and the judge randomly assigns a bankruptcy trustee to seize my assets, auction them off, and pay my creditors. How does an ABC differ?
The most fundamental difference is that an ABC is a state-governed, non-judicial process. It happens entirely outside of the courtroom. It is rooted in contract law rather than federal bankruptcy law. Because you don't have to navigate federal court dockets, it is significantly faster and drastically cheaper. Furthermore, because it isn't a federal court proceeding, it offers a much higher degree of privacy for the business owner and the creditors.
So it's essentially a privately managed liquidation, but who manages it? If I don't get a random court-appointed trustee, who takes control of the assets?
That is the most powerful advantage of an ABC. The business owner, known as the assignor, actually gets to choose and hire the liquidator, who is known as the assignee.
Wait, I can just hire my buddy to liquidate my company and pay off my debts.
No, you can't hire your buddy. The assignee must be an independent, specialized fiduciary. They have a legal duty to maximize the return for your creditors.
Okay, how does that start?
Mechanically, you draft an assignment agreement, which is a massive contract. You formally transfer the legal title of every single asset your business owns, equipment, inventory, intellectual property, accounts receivable, to this fiduciary assignee. You step away, and the assignee takes over the operations.
So they're in charge now.
Right. Their sole job is to professionally market and sell those assets, and then distribute the cash to your creditors according to the strict priority rules established by state law.
If it is cheaper, faster, and I get to pick the liquidator, why doesn't everyone just do an ABC instead of Chapter 7? What is the mechanical drawback?
The primary drawback is the lack of an automatic stay.
Explain the automatic stay. What does that shield actually do?
In a federal Chapter 7 bankruptcy, the very second your petition is stamped by the clerk, a federal injunction called the automatic stay drops over your business like an impenetrable dome. It legally mandates that all collection activity must instantly cease.
So no more phone calls.
Creditors cannot call you, they cannot send letters, existing lawsuits are frozen in place, and sheriffs cannot seize your property. If a creditor violates the automatic stay, they can be severely sanctioned by a federal judge.
It is absolute breathing room.
Exactly. But an ABC does not have that federal magic wand. Because it is a private contract, there is no automatic stay. Aggressive creditors can technically refuse to participate in the ABC process and continue to sue the business or attempt to attach assets.
So if there's no shield against lawsuits, in what specific scenario does an owner choose the ABC?
You choose an ABC when the value of your assets is highly specialized. Let's look at a hypothetical scenario. Imagine you run a specialized biomedical software company. You have thousands of lines of proprietary code. If you file a federal Chapter 7, the court might assign a trustee whose background is in liquidating restaurants and hardware stores.
Oh, I see where this is going.
Right. That trustee looks at your code, has no idea how to value it or who to sell it to, and ends up auctioning it off to a bottom feeder liquidator for pennies on the dollar.
Which means your creditors get almost nothing, and if you signed personal guarantees, the bank is coming after your house for the massive remaining balance.
Precisely. But if you execute an ABC, you can proactively hire an assignee who specifically specializes in the tech sector. That assignee knows exactly which rival tech companies want to buy your code. They market it properly, they create a competitive bidding war, and they sell the software for its true maximum market value.
Which generates a massive pool of cash, pays off the bank in full, and completely extinguishes your personal guarantee exposure. The mechanics of choosing the right venue are critical. But what if the business isn't dead? What if the software is great, the customers are happy, but the business is just temporarily choking on bad debt and needs legal breathing room to restructure? This brings us to reorganization.
If the underlying business model is viable, you move away from liquidation strategies and you look at the formal bankruptcy chapters designed strictly for reorganization.
Let's walk through the mechanics of these chapters because they serve very different purposes. Let's start with the most famous one, Chapter 11. We hear about massive airlines and retail chains filing Chapter 11 all the time.
Chapter 11 is the gold standard of reorganization. Mechanically, it allows the business to continue operating as what the court calls a debtor in possession.
Meaning management isn't fired, you stay in the driver's seat.
Yes, you maintain control of the company's daily operations while you negotiate a massive, complex repayment plan to restructure your debts over time. However, I want to use an analogy here. Traditional Chapter 11 is like trying to turn a massive cruise ship.
Okay, a cruise ship.
Right. It requires an enormous crew, it takes a vast amount of time, and it burns a staggering amount of fuel, which in this case is money.
Why is it so expensive? What are the specific mechanics that drain the cash?
Two main things. First, traditional Chapter 11 requires the formation of a creditors committee. The court gathers your largest unsecured creditors, the vendors you owe the most money to, and forms them into a powerful committee to oversee your reorganization.
And the kicker.
The kicker is that the debtor is legally required to pay the attorney fees and financial advisor fees for that creditors committee.
Wait, I have to pay my own bankruptcy lawyers, and I have to pay the incredibly expensive lawyers representing the people I owe money to.
Exactly. For a small business, those professional fees alone will drain whatever operating cash you have left in a matter of weeks. The second massive hurdle is the voting process. In traditional Chapter 11, the creditors actually get to vote on whether to approve your proposed reorganization plan. If they don't like the terms, they can vote it down, and the court can force you into liquidation.
So a traditional Chapter 11 is a massive, expensive, politically fraught cruise ship that is entirely unsuited for a small business. But our legal sources highlight a recent evolution in bankruptcy law that completely changes the game.
Yes, we are talking about Subchapter V. This was introduced under the Small Business Reorganization Act of 2019, and it has revolutionized the legal landscape. The United States courts data shows exactly how powerful it has become. In the first quarter of 2026 alone, Subchapter V filings surged by 67%, hitting 833 filings.
If traditional Chapter 11 is the cruise ship, Subchapter V sounds like a high-speed speedboat. What makes it so agile? First, who actually qualifies for it?
There is a strict entry gate. Currently, your business must have less than $3,424,000 in non-contingent liquidated debt to be eligible.
And if you slip under that debt ceiling, what do you get? Let's mechanically break down why Subchapter V is the ultimate lifeline.
It strips away all the expensive architecture of the cruise ship. First, there is generally no creditors committee. That single change saves the small business hundreds of thousands of dollars in professional fees. You do not have to fund the lawyers who are fighting against you. Second, it fundamentally alters the balance of power regarding your reorganization plan.
How so? In a traditional Chapter 11, you said the creditors get to vote.
In Subchapter V, there is no creditor voting requirement. You draft your reorganization plan, which proposes how you will use your future disposable income over the next 3 to 5 years to pay down your debts. You submit that plan to the bankruptcy judge.
And then,
if the judge determines that the plan is mathematically fair and equitable, the court has the power to force that plan upon the creditors, even if every single creditor violently objects.
the court just rams it down their throats.
That is precisely the legal term for it. It is called a cram down.
That is an incredible lever of power for the small business owner. But there is a third benefit that our sources flag as the most vital aspect of Subchapter V, and it deals with who actually owns the business when the dust settles.
We need to explain a deeply entrenched bankruptcy concept called the absolute priority rule. In a traditional Chapter 11, the absolute priority rule dictates a strict waterfall of who gets paid first. Secured creditors at the top, unsecured creditors in the middle, and equity holders, the business owners, at the very bottom.
Okay, so owners are last in line.
Yes. Mechanically, the rule states that the equity owners cannot retain their ownership interest in the business unless all the unsecured creditors above them are paid back 100 cents on the dollar.
Which never happens in bankruptcy. If you could pay everyone 100 cents on the dollar, you wouldn't be in court. So in traditional Chapter 11, the owner almost always loses their shares. The creditors end up owning the company.
Exactly. It destroys the incentive for a small business owner to even try to reorganize. Why go through the hell of bankruptcy just to have your company taken away from you?
Yeah.
But Subchapter V completely abolishes the absolute priority rule for small businesses.
Let me make sure I understand the mechanics of this. Under Subchapter V, a business owner can go to court, propose a plan that only pays unsecured creditors 20 cents on the dollar over 3 years, use a cram down to force the creditors to accept it, and at the end of the process, the owner still owns 100% of the equity in the company they built.
Yes. That is the exact mechanical reality of Subchapter V. It allows the entrepreneur to survive the storm, shed the unmanageable debt, and keep the fruits of their life's work.
Let me throw a real-world scenario at this speedboat. A massive unforced error we discussed earlier is signing a terrible, suffocating commercial lease. Let's say I opened a restaurant and I signed a 10-year lease at the absolute peak of the market. The rent is killing me. If I file Subchapter V, can this process get me out of that specific contract?
It absolutely can. The power to break contracts is embedded in Section 365. As a debtor in reorganization, you have the unilateral power to either assume or reject what are called executory contracts and unexpired leases.
What does reject actually mean in practice?
It means you can legally walk away. If you have an above-market lease that is bleeding you dry, you file a motion to reject the lease. You hand the keys back to the landlord.
But won't the landlord sue for the rest of the lease?
The landlord will claim you breached the 10-year contract and demand millions in future rent damages. But the magic of the bankruptcy code is that it strictly caps the landlord's damages, usually limiting their claim to just 1 year of rent or 15% of the remaining lease term.
That's a huge reduction.
Yes, and that capped damage amount is then lumped in with all your other unsecured debt, and it gets paid off at pennies on the dollar through your reorganization plan.
You essentially surgically amputate the bad real estate deal, cap the bleeding, and save the core business. It's an incredible tool. Okay, so Subchapter V is for corporate entities under the debt limit. What if I am that sole proprietor again, the graphic designer or the plumber, and I need to reorganize my debts?
A sole proprietor cannot file Subchapter V. You would look to Chapter 13 bankruptcy. This is designed for individuals with regular income.
How does the Chapter 13 mechanism work?
It is functionally similar to a reorganization. You do not liquidate your assets. You get to keep your house and your car. Instead, you propose a strict 3 to 5 year repayment plan to the court. You must commit all of your disposable income, which is your income minus necessary living expenses defined by the IRS, to paying down your debts over that period.
Are there limits on who can use Chapter 13?
Yes, there are strict statutory debt limits. Currently, you cannot have more than roughly $419,000 in unsecured debt, like credit cards or vendor bills, and no more than $1.25 million in secured debt, like mortgages. If you are over those limits, you are forced into an individual Chapter 11, which brings you right back to the expensive cruise ship.
I see one more chapter listed in our legal stack. Let's touch on it briefly because it highlights how specific the law can be. What is Chapter 12?
Chapter 12 is a highly specialized restructuring mechanism designed strictly for family farmers and family fishermen.
Why do they get their own chapter?
The legal architecture recognizes that a farm operates on fundamentally different mechanics than a retail store. A farm's revenue is entirely dependent on unpredictable exogenous forces, the weather, global commodity prices, droughts. Therefore, Chapter 12 has much higher debt limits than Chapter 13, and it offers incredible flexibility to restructure loan payments based on the seasonal reality of agriculture. If a drought wipes out the harvest, the Chapter 12 plan can mechanically adjust to defer payments without defaulting.
So we've built a comprehensive map. We have out-of-court strategies like the ABC for specialized liquidations, and we have in-court reorganizations like Subchapter V for restructuring. But we have to face the final, hardest reality. Sometimes, despite the best advice, despite cutting the fat, and despite exploring bankruptcy, a business simply has to die. The market has moved on, the technology is obsolete, and the math no longer works. How does an owner shut down a business responsibly without having the liability trail them for the rest of their life?
Winding down a business is not a matter of simply locking the front door, unplugging the phone, and walking away. That is how you guarantee massive trailing liabilities. The QuickBooks source provides a highly structured 10-step mechanical guide to dissolution. The overriding principle here is systematic containment.
Let's walk through the critical milestones of that final wind down. Where does an owner start when they know the end is near?
You start by creating a formal, written exit strategy. You have to map the timeline backward from your final day of operations. The most delicate part of this timeline is human resources. You must legally and ethically notify your employees.
Are there specific legal landmines when laying off an entire workforce?
Yes. If you operate a larger enterprise, specifically if you have 100 or more full-time employees, you must strictly comply with the Federal WARN Act.
The WARN Act?
Right, the Worker Adjustment and Retraining Notification Act. It legally mandates that you provide 60 days advance written notice of a plant closing or mass layoff. If you fail to provide that 60-day notice, your company is legally liable for back pay and benefits for every single day of the violation, plus severe civil penalties.
That is a massive unexpected liability if you just try to shut the doors overnight. Okay, so you handle the human element legally. What is the next mechanical step regarding your assets?
Timing is everything here. You must aggressively collect your accounts receivable before you make any public announcement that the business is closing.
Why is the sequence so important?
It is human psychology. The exact moment the market realizes you are going out of business, your leverage to collect debts drops to absolute zero. If a client owes you $10,000 and they know your phone lines are getting disconnected next week, they will simply throw your invoice in the trash.
Because they figure you won't come after them.
They know you don't have the resources to hire a lawyer to sue them. You need to collect that cash while you still project the image of an ongoing operation, because you desperately need that final pool of cash to settle your core debts.
All right, the AR is collected. Now you have to deal with the physical stuff. The desks, the computers, the specialized manufacturing equipment, you have to liquidate it. But our legal sources issue a massive warning about the specific language you use when selling off company assets.
This is a critical mechanical detail. When you sell a piece of equipment, you must execute a non-recourse bill of sale.
Let's break down the legal mechanics of that phrase. Why is it necessary?
Imagine you sell your company's industrial printing press to a competitor for $50,000. You shake hands, you take the money, you pay down your bank loan, and you dissolve your LLC. 6 months later, that printing press catches fire and burns down the competitor's factory.
Oh boy.
If you use a standard bill of sale, that competitor's insurance company is going to hire an army of lawyers to sue you, claiming you sold them defective equipment and breached an implied warranty.
And since your LLC is dissolved, they might try to pierce the veil and come after your personal assets.
Exactly. A non-recourse bill of sale explicitly blocks this. It includes legally binding language stating that the asset is being sold strictly as is, whereas with absolutely no warranties, express or implied. It explicitly severs any future liability. It legally dictates that the buyer accepts 100% of the risk the moment the asset leaves your floor.
You are systematically building a firewall behind you as you walk toward the exit.
Yeah.
So the assets are sold safely, the employees are handled, the remaining cash is distributed. How do you officially kill the entity?
You file articles of dissolution with the state where you incorporated. This officially terminates the legal existence of the LLC or corporation. You must also formally cancel all state and local business licenses, and you must file your final tax returns with the IRS, explicitly checking the box that says Final Return.
So the entity is dead, but does the paperwork disappear? How long do I need to keep the ghost of this business in my filing cabinet?
The IRS mandate is clear. You must retain all foundational business records, tax filings, payroll records, and employment documents for a minimum of 3 to 7 years after dissolution. Just because the business ceases to exist does not mean the IRS cannot audit its final years of operation.
Okay. The business is closed. The records are boxed up in the garage. The debts are either paid, settled, or discharged in bankruptcy. I want to talk about the human element, the owner. Can they ever start over? Or are they branded with a financial scarlet letter? Are they legally barred from ever being an entrepreneur again?
You can absolutely start over. There is no law in the United States preventing an entrepreneur from starting a new business the day after they finalize a Chapter 7 liquidation. In fact, the entire philosophical premise of the bankruptcy code is to provide the honest but unfortunate debtor with a fresh start.
But I imagine the courts are watching very closely to make sure you aren't playing games with that fresh start.
They are watching with a microscope. You have to navigate a legal landmine known as the mere continuation doctrine.
Explain the mechanics of that doctrine. What is the court looking for?
The courts apply a substance over form test. They want to make sure your new business isn't just the old, bankrupt business wearing a fake mustache, designed specifically to defraud your previous creditors.
Give me an example.
If you liquidate Smith Plumbing LLCs on a Friday to wipe out $200,000 in debt, and on Monday you open Smith Plumbing 2.0 LLC, operating out of the same building, using the same trucks, servicing the same clients, with the exact same management, the courts will rule that the new company is a mere continuation of the old one.
And what is the penalty for that?
The judge will simply transfer all of the old discharged debt onto the new company. The creditors get to attack you all over again.
So how do you actually start over cleanly?
You need total separation. You need a completely new name, a fundamentally distinct operational structure, new capitalization, and ideally a new market approach. You have to build something truly new. And rebuilding your personal financial life will require immense patience.
Mechanically, what does that personal rebuild look like? Your credit score is likely in the basement.
You start small. You will likely need to rely on secured credit cards initially, where you deposit cash as collateral. You will have to slowly open new trade credit accounts with vendors, and they will likely demand strict net 10 terms until you prove your reliability.
It's a slow climb.
It is, but the most valuable asset you bring to the new venture is the visceral education you just survived. You don't repeat the unforced errors. You obsessively monitor your cash flow. You refuse to take on toxic high-interest debt. You understand exactly what a personal guarantee is, and you negotiate aggressively to limit it.
You essentially build the next fortress out of actual concrete instead of relying on a piece of paper.
Precisely. And what's fascinating here is how the cultural conversation around failure is shifting.
I agree completely. Decades ago, filing for bankruptcy was viewed as a profound moral failing. It was shameful. But today, especially given the macroeconomic environment we detailed in the first quarter of 2026, the stigma is fundamentally changing.
Yeah, it really is.
The market understands that businesses can fail for reasons entirely outside an owner's control. With the right legal advice, bankruptcy isn't an admission of moral defeat. It is simply a highly regulated mechanical tool designed to cleanly reallocate resources in a capitalist system. It is a legally sanctioned mechanism for survival.
And that shift in perspective is what allows entrepreneurs to get back up and try again, which is what actually drives the economy forward.
You, our listener, have been on a massive, intense journey with us over this deep dive. We started by looking at the terrifying macroeconomic engine driven by consumer exhaustion that is pulling small businesses under right now. But, more importantly, we focused on the mechanics of the unforced errors, the mistakes you actually have the power to control.
We covered the absolute necessity of optimizing your cash flow and ruthlessly cutting expenses, including negotiating with hostile landlords to avoid the brink entirely.
We navigated the incredibly dangerous hidden trapdoors of personal guarantees. We broke down the vital mechanical differences between limited, unlimited, and the devastating joint and several liabilities. We exposed the absolute nightmare of the IRS trust fund recovery penalty and explored exactly why the federal government will pierce your corporate veil and ruin your life if you ever use employee payroll taxes to pay your commercial rent.
And we explored the strategic lifelines available when the debt truly becomes unmanageable. We compared the mechanical privacy of an out-of-court assignment for the benefit of creditors against the powerful federal shield of a Chapter 7 liquidation. And we highlighted the incredible reorganizational power of Subchapter V, explaining how a cram down allows you to shed bad debt and break leases while keeping your equity intact.
It has been the ultimate mechanical survival guide for the modern entrepreneur. But before we sign off, I want to leave you with one final thought to mull over. We've spent this entire session analyzing the supposed concrete wall of limited corporate liability. We've seen exactly how easily that corporate veil is pierced by everyday lending requirements, alter ego operations, and statutory IRS penalties. It begs a fundamental question in our modern, hyper-connected financial system where data is infinite and risk is algorithmically assessed. Is the traditional concept of limited liability for small business owners actually just an illusion? If you have to personally guarantee your commercial lease, your bank loans, and your vendor accounts just to survive the initial startup phase, who is really taking the economic risk? The paper corporation registered with the state or the human being standing behind it? Thank you for joining us on this deep dive. Please go pull out your vendor contracts, review the fine print of your credit agreements, and understand exactly what legal mechanics you have signed on to before the unexpected rainy day arrives. Take care.
Thank you from all of us at Murphy Business Sales for taking the time to learn about this important topic. We look forward to working together to achieve your business aspirations. For more information or a complimentary consultation for sell-side services, visit us at murphybusiness.com/Edison and complete our Contact Us form.